Welcome to Elliott Wealth Management Services 2026 Mid-Year Economic Update. This is Christopher Calandra speaking. I'm joined by Brett DePasquale, and we want to share with all of you some of our thoughts about where the economy is, and by extension, the markets, now that we just passed the mid-year mark of 2026. Brett, I appreciate you joining me, and I'm anxious to share some excellent information with everybody listening. Why don't you kick it off, the 2026 year in review so far?
Yeah, thanks for having me, Chris. Always good to be here. Um, Going into 2026, I think for the first half of the year, we've seen some major excitement. I think you'd agree with that. A couple major different talking points and bullet points have highlighted the year so far. But overall, it's been a strong year. I mean, as of July 1st of this year, markets back to all-time highs. So coming into 2026, we always had a case for optimism. At Elliott Wealth, we were pretty optimistic about where the market was going to take us for this year, just based off of a lot of economic factors. But we saw some things happen in the first quarter of the year, such as the Iran conflict. We have some concern around interest rates and really some uncertainty, really. We saw oil prices go to the highest levels they've been at in a very long time. And we've also seen inflation start to decline and then really tick back up again. So it's been a lot of things going on the first half of the year. But where we're sitting now, I think really positions the market for a decently strong finish for 2026. What do you have to say about that?
Yeah, I think you nailed it. When you look at the major headlines, they are very worrisome the first part of the year, punctuated by the Iran conflict. It's a disconnect though, because when you look at the performance of the stock market using the major market indexes like the S&P 500, the Dow, and the Nasdaq, they've shrugged off these major headline concerns that drive the news and the media, especially the mainstream version of those. And the market has been very healthy and has been able to shrug off and look beyond these major headlines. So a big time disconnect between what you think you're seeing in the news and then you look at your 401k or investment accounts. It's hard to square the two. That's how kind of I look at it. We do have a number of things that we're optimistic about. So take us through some of those, Brett.
Yeah, I will. One other thing that I'll add is a lot of pundits, if you watch the news, good for you, good for you. You're putting yourself in for a hurting. A lot of the pundits are saying that the market right now is driven off of fear. And if you really look at what the fear index is, so the VIX, which measures the amount of volatility in the market, it's actually sitting at almost the all-time low. It's very close to it. So the VIX doesn't show a bunch of fear in the market, to your point, that they've kind of shrugged off all these big tensions.
Yeah, absolutely. And I'm fond of saying, you've heard me say this as we've worked together for several years now, is the media's job is not to help you make good financial decisions. That's not what their goal is, so don't use them for that. I think you and I share a common thing that we I don't watch the news. I do read a lot. I'm well informed, but I'm not watching the nightly news because nothing good could come of that.
It's true.
So what are we optimistic about?
Yeah, so I think first and foremost is where the S&P is right now. I mean, it's top 7,500. It's floating around that number as we're having this conversation. But I mean, I think overall for the year, that puts us on a really good track performance-wise for the year and also shows kind of where the economy is. So that's first and foremost. Second thing is what you're going to get into in a little bit more detail, or corporate profits are accelerating, which are really helping drive the market over, especially the past couple months here. Obviously, we have some reduced tensions in the Middle East and Iran now. I wouldn't say a peace deal because we've seen some more shooting, some more uncertainty, but I think tensions overall, we can agree that they are reduced from where they were back in the April timeframe, April, May timeframe. We've also seen oil prices finally retreat back down to the $70 range, all the way up from the $110 range. Now, it's important to note too, with oil prices, that doesn't drive gas prices. A lot of people think that the two are extremely correlated, but as oil prices come down like a rock, gas prices, I believe, will start to come down like a parachute or with a parachute. So a lot slower than expected. So that pain at the pump, I think, is still going to stick around for a little bit, but I think we're trending in the right direction, which is good. Also, small cap stocks, so smaller companies are really thriving in this economy. I think mostly based off of the new tax law put into place and the big one big beautiful bill in July of last year, really helping out small and medium-sized businesses. So they really flourished. And then also there's been the technology and AI rebound. So a lot of talk around the AI tech bubble bursting. We saw them pull back in the first quarter, end of first quarter of this year. But they've really also, I mean, they've been crushing it the past couple months here and really led to some good gains. So I think we have a lot of things to be optimistic about, um, and really sets us up well for success going into the second half of the year.
Yeah, before we move on, I want to build on two points you made. Small cap stocks have strengthened. In addition to what you already shared, it seems to me this also is an indication that small cap stocks generally are not going to rally when there's a recession on the horizon or fears of a recession. So I think that is an indication of number one, it's small caps turn to sort of shine after being overshadowed for quite a while and underperforming for quite a while. I also think number two, it's a sign of economic strength moving forward and confidence that the economy can continue to grow and move forward without concerns over a recession. In terms of technology and the AI rebound, the US economy is largely growing and prospering. The stock market is being propelled by this revolution that's happening in AI spending, expected efficiencies, and it's just a dynamic time for the economy with this very powerful AI, artificial intelligence coming down the pike that is already changing things. And I don't even think we've even gotten started yet, but that likely spells more good things to come for the markets and the economy. That's not a guarantee, but that's why it's under the causes for optimism. And let's talk a little bit about corporate profits. Uh, I just touched on this. The US corporations, big companies, especially tech companies, they are doing very well as judged by the most important thing, and that is profits. Companies in the United States are very profitable, and the expectations moving forward is that there will be continue to be profit growth. And as one of my favorite economists, Larry Kudlow, is fond of saying, profits are the mother's milk of the stock market. It is often overlooked and not talked about as much as it could be or should be, but that's really ultimately, especially over the long term, what's going to drive the markets higher. So we've had very good profitability. Expectations is that that profitability will continue to grow. Additionally, it's worth noting that we not only have good profits in 2026, but we are exceeding expectations. So when Wall Street looks and says a company is going to earn X, that company is often, by and large, coming in at X plus. So we were expecting good profits and we're getting even better profits than anticipated. And it's a very rosy scenario moving forward into 2027 for corporate profitability. And if you wanted to look at just one thing on why the stock market has been prospering, I think that would be the one thing I would pick. Of course, it's not just one thing. There's lots of elements that go into this, but I think it's a key one. What do you think, Brett?
Yeah, absolutely. I mean, the more money corporations make, makes for a very healthy market and very healthy earnings. So I think that's spot on.
It is not as if we are all pie in the sky, everything is rainbows and unicorns. There are a number of things that we could be pessimistic about, things that we want to follow to make sure that it doesn't upend the apple cart and change what we think is generally an optimistic view moving forward. What are some of the cases for pessimism?
Yeah, so like you said, it's very important that we stay balanced when we take a look at the totality of the economic situation. So we're always going to be able to give the optimism and the pessimism. That way, when we're taking a look at how we manage portfolios, we have both sides of the story, which I think is really important. One of those things is going to be the continued market volatility. We've seen it in the past couple months here, and we expect it even more. We're in a midterm election year, so historically, it's the worst performing year in a 4-year election cycle. So we're always going to be a little bit concerned about that, but we're just going to keep our eye on potential power shifts. Second thing is going to be the conflict in Iran. So obviously we're not to the end of that yet. Looks like we're nearing the end of it, but that's something that could always upend some of the growth that we've had, or even given any other type of new conflict that arises. Piggybacking on that would be energy price concerns. So obviously, oil is of top of mind from people right now, and that is driving a lot of what's going on in the market as well. So as long as oil prices stay where they are, I think that's going to be pretty comfortable. Um, Tech stocks, a lot of people are asking about all these tech stocks that have provided a lot of the growth over the past couple years in the overall market. They continue to be volatile, but at the same time, they're profitable. So it's one of those give and take situations that we just have to be mindful of. And then last, I hit on it a little bit, is the political uncertainty. We'll see what happens in the House of Representatives and the Senate in this upcoming midterm election year. It looks like the Democrats will take control of the House of Representatives. The Republicans, it's really a toss-up, but we'll see what happens with that. So markets don't like uncertainty. So up until that election, I think we'll get some of that.
In terms of the energy price concerns, I will mention that it plays into inflation. Inflation is not nearly as problematic as it was a few years ago. The trend, though, has not been very good since Trump got into office for his second term. It's increased. It's slow. It's gradual. It's not the right trend, though. And with the shooting starting in Iran a little bit ago, it inflamed this already sort of percolating issue with inflation ticking up a little bit. I think my base case, and I believe you agree with this, the whole team here at Elliott Wealth does, is that it will subside because energy prices will come down. They already have, and that will help inflation gradually work its back to where it once was. Call that the beginning of the Trump administration. But a concern is if things remain hot in the Middle East, if other factors come into play and you have inflation continue going in the wrong direction, that would be a very big headwind for the economy and the markets. And that would be something we would be a bit worried about, don't you think?
Absolutely.
So let's talk a little bit more about inflation on where we are now, Brett.
Yeah, so just wanted to make a point that as of May, inflation is actually the highest it's been since 2023, which I think is a pretty staggering statistic. Began the year at 3.2%, so it's ticked a little higher. And the big thing that is tied to that are interest rates. So as the Federal Reserve goes to their meetings and they decide whether to keep rates steady, cut rates, whatever, or even increase rates, there's been some rumblings of a raise in interest rates by the end of this year. Personally, I don't think that rates will be increased. I think they're going to stay steady. How steady they'll stay for the longer term is kind of to be determined based off of that inflation number. But really, interest rates are really influencing what the markets are doing right now. I think it would be not a great situation with an uptick in interest rates for the overall market. What do you think, Chris? Do you think interest rates will stay steady? Do you think they're going to increase, decrease? Where are you with that?
I think, especially more recently, with oil prices coming off the highs that existed when things were very hot with the Iran conflict, that they'll stay where they are. The Federal Reserve will just hold pat. And unless you see a little bit stronger movement on the upside in inflation, which I don't think is what I would expect, I think they're likely to stand pat for quite a while. My best guess would be that for the next 9 months, we don't see the Fed do much other than sit and wait and see what happens. So I do not forecast rate increase either.
Very
And we do
good.
have new leadership at the Federal Reserve. That's worth mentioning too. We had President Trump appoint a new Federal Reserve chair, that is Kevin Warsh. And so he'll be tested like all Federal Reserve chairmen are. He supposedly, if you listen to some people, is more dovish, meaning that he'll be anxious to cut interest rates. Others think that he could be very aggressive in fighting inflation and increasing interest rates. I think the reality is, Brett, we really don't know what type of leader he'll be for the Federal Reserve. And that's why I think both of us say, well, he'll probably just wait and see, and nothing will happen over the next stretch, which probably is a positive thing, don't you think?
Yeah, I'd agree. I'd agree. I think any type of upending of the current situation would cause a little bit of, I'll call it chaos, but it's not chaos. I think you know what I mean.
Yeah, we talked about the Iran conflict a little bit, just sort of in passing, but it deserves a little more attention. In terms of the Iran conflict, we already talked about conceptually that did a lot of things. One of them was to push the price of oil up from about $60 a barrel to $115 a barrel. As Brett already stated earlier in this discussion, it's already come down as of this recording to around $70 a barrel, give or take. So things have improved quite a bit. It's also worth noting that some of the talking heads in the media early on the Iran Contra, that's a throwback, the Iran conflict, we're talking about the great likelihood that oil went to 150 or $200 and the sky is falling. None of that materialized, which again is why we largely ignore the news. But talk, Brad, a little bit about the consumers.
Yeah, I mean, obviously consumers are feeling the pain at the pump lately. Those prices, like we said, are slowly beginning to decrease. But one of the questions I've been getting a lot from clients is on oil prices. And when we think about oil, we think about gas. That's just the natural state of thinking. But what we really don't realize is oil drives a lot of supply chains overseas. So when you're out buying clothing, athletic wear, whatever it may be, you got to remember that a lot of these clothes, a lot of these products are made with oil-based products. So as much as Americans can be oil independent in the fuel situation, a lot of these companies are still making clothing, other products overseas, which is reliant on overseas oil. So all of that ties into the overall supply chain. So when we talk about this conflict and oil prices rising, it affects the entire economy, not just what you're paying to fill your car up.
Yeah, that's a very good point. Another point you referenced earlier that I want to delve into in a little greater detail is the midterm elections. I've seen a lot of elections over the course of my long career. I know you have as well. Let's just bring everybody into our orbit in terms of how we want to think about the midterm elections using history as a guide. Touch on that, please.
Yeah, so obviously with any election year, that leads to uncertainty, like we talked about. And uncertainty leads to volatility, but mostly it's short-term volatility because once the elections happen, this uncertainty goes away to an extent. So just looking at on a percentage basis, right now there's a 55% chance that the Republicans keep their majority in the Senate. There's also an 84% chance that the House of Representatives flips to Democrat. So that's a pretty, let's call it a toss-up for the Senate at 55%. But that's a pretty strong number at 84% that the House will flip over to Democratic control. So until we see what that Senate number looks like, if it's a fully Democratic controlled House and Senate, that looks a lot different than a split House and Senate. So that adds to some uncertainty there. And I think it's also important to note, too, like I said, per 4-year election cycle, this year should be the weakest year for market returns, and they usually historically average around 6 to 8% per year, which is a nice return, but comparatively to the other three, it's the weakest. So we'll see how this all shakes out coming down into November timeframe.
I think, personal opinion, that the 55% likelihood that the Republicans keep the Senate is much, much too low. I would put that more in that 75-80% likelihood that the Republicans do retain control of the Senate. And then also, I think that the 84% chance that the House flips to the Democrats is higher. I think there's a greater chance that the Republicans can fend off the Democrat challenge and maintain the majority. I would still say the Democrats have a greater likelihood than the Republicans, but I don't think it's an 84% chance. I think it would be more like 60-40. We'll see how that plays out. Obviously, I don't control elections, far from it. But I would, if I was a betting man, and I'm not, I would bet that the Republicans would keep the Senate. Is that where you would put your money?
I would think so, yeah. And since we're of the people here at Elliott Wealth, these numbers came from Polymarket, so that way we see what the people are thinking. So this is our sample size of the general public's thoughts. But I tend to agree with you, Chris, that the number 55 is low and the 84 is high.
I appreciate that. We want to finish up here soon, but we would be remiss if we didn't talk a little bit about handling market volatility. And we have had a decent amount of market volatility, and that will continue. It has over the long arc of history. Talk to everyone about an appropriate approach to handling market volatility.
So, I mean, I think the best thing is everyone likes, everyone feels good when the market goes up, and they feel terrible when the market goes down even a little bit, especially over the past couple years. People are used to really good returns, and they really feel the pain of any sort of market dip. Biggest thing is to focus on what your long-term goals are. Any type of financial planning that you've done should be based off of overall goals over a long period of time. So stick with the plan that you have and just understand that go and trust your experts. Trust the people that manage your money. Trust the people that are doing your taxes. They are going to be your most unbiased source of information when it comes to your personal situation. At Elliott Wealth, we have our investor best practices. I think that's a great piece that just is a reminder that markets go up, markets also come down, but the plan should be tailored for what your specific situation is, and then buy into that plan and stick to it.
And we already hammered the media a decent amount. We'll go back to that and say that the news is not the best source of information. And the last point that I will make is that you and your family are on your own journey, and keeping that in mind, not comparing yourself to what the news says or what the guy down the street says or somebody else talks about at work, that you're on your own journey and hopefully have your own plan as guided by us here at Elliott Wealth Management. That I think can help with the anxiety that sometimes comes with the market volatility, which inevitably we have to deal with as good long-term investors. Thank you, Brett. Thank you, everyone, for listening to the mid-year 2026 economic update provided by Brett DePasquale and Elliott Wealth Management Services, with me helping out Brett, Chris Calandra. So thank you very much. And we will be back with you on another economic update in January, but let's not rush the rest of 2026. Time is already moving fast enough. Thank you.
Absolutely.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues, or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.